he get that message?
Yeah, you're live now. I'm sorry.
Thanks, Sean. I'd like to call to order the quarterly board meeting of the Kentucky Retirement System. And with that, will Michael Board please read our legal public statement?
Yes, ma'am. This is a regular meeting of the Kentucky Retirement System's Board of Trustees. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date. Thank you.
Thank you, Michael. And Sherry, would you do the roll call?
Yes, ma'am. Ms. Hampton,
Here.
Mr. Atkins, Ms. Bova, Ms. Eves,
Here.
Mr. Lane,
Here.
Dr. Miller,
Here.
Mr. Piercy,
Here.
Mr. Summers,
Here.
Ms. Thompson,
Here.
and Mr. Atkins. He was getting on. Let's make sure he can join us. I know I let him in.
Here.
Oh, there he is. Thank
Thank
you.
you.
Sherry, do we have any public comments?
Yes, ma'am. There are 2 public comments we received for this meeting. The first one reads as follows. It's from a James Shepard Olive, and it reads as follows. Dear folks, my pension from Kentucky Public Pensions Authority, KPPA, has had no cost of living adjustment since July 2011. According to an online inflation calculator, www.bls.gov/data/inflation _calculator, the U.S. Bureau of Labor Statistics, BLS, data shows inflation has reduced the purchasing power of $10,000 to $7,183 today. This is a 39.2% reduction from the 2011 amount. Meanwhile, my expenses for basic needs have at least kept up with inflation. Things are getting tighter. Meanwhile, reports of a massive end of fiscal year state budget surplus have come and gone for another year in succession. It takes more than a few very large grains of salt to reconcile the apparent disparity of these surpluses with a 13-year stasis in my pension. I respectfully implore you to strongly advocate and advance relief for help in improving the bottom line of KPPA non-hazardous retirees. Best regards. The second public comment came from a Andrew Radowski, and it reads as follows. Dear members of the KPPA board, thank you for allowing me to submit a public comment today. I would like to address an important consideration regarding retired veterans and their participation in the healthcare and pension programs managed by KPPA. As you know, most veterans are covered by VA healthcare benefits, which are an essential part of the support they receive after their service. However, it's important that veterans be given an option to opt into or opt out of additional health insurance programs and funds like the 1% fund. Since veterans already have access to VA healthcare, it may not be necessary or beneficial for them to be required to contribute to additional programs if they are already covered. By allowing veterans to make the choice about whether to participate in this fund, the board would be recognizing their unique circumstances and offering them greater flexibility in managing their health care and financial security in retirement. This would ensure that no one is paying into a system they may not need, while still giving them the opportunity to participate if they choose to. I urge the board to consider this opt-in option for veterans, and I appreciate your attention to this matter. Sincerely, Andrew Radowski, U.S. Army retired. Thank you.
Thank you very much, Sherry, and I'm sure you all will take care of the correct distribution of the letters. Thank you very much. Okay, with that, I think we have minutes. We have minutes of the June 18th, 2024. Are any comments or any changes to the minutes? Okay, without that, no discussion, all in favor?
Aye.
Opposed?
I'm sorry, we need a motion first.
Okay,
I'll make a motion.
okay, then we'll redo that. Okay, all in favor?
Aye. Aye.
Opposed? And the motion is passed. Okay, the next is the Joint Retiree Health Plan Committee, and with this, we have Dr. Miller, who would like to get started.
Yeah, hi, I will pass to Connie. She is definitely more of an expert and can explain this better than I can. We had a long, lengthy meeting, and I think we accomplished a lot.
Thank you, Dr. Miller.
Yeah, before they get started, if you could make the text a little bit bigger on the screen, Sherry. Yeah, that's good. Thank you.
I wanted to discuss first the plans. There's probably two votes here, and to accept the recommendations. First, the committee looked at the Kentucky Employees Health Plan. That's the one the non-Medicare eligible retirees are enrolled in. There's around 28 to 30,000 covered lives on insurance in this plan, and for 2025, the Department of Employee Insurance, who's the plan sponsor for this self-insured state plan, went out to bid this year for the medical benefits, and they just signed the contract last week with Anthem to continue as the third-party administrator for the medical portion. At this time, there's no other change to the other vendors except the Alight audit is being discontinued as of June. So that's no longer a vendor that will be sending out the dependent verification letters to the employees or to the retirees or employees. So the premiums are the same. The legislators did add one new plan. They wanted a high deductible option for state employees and retirees, which is relatively low in cost and really only covers catastrophic. So other than that, there are no changes to the premiums and there are no changes to the benefits other than what I mentioned, which was an Alight audit function. So first the committee looked at the contribution plan and they decided to continue going with the KEHP Living Well PPO plan as the contribution for those retirees hired prior to 7103 and who are participating before that date and have 240 months of service credit or greater. And the hazardous duty retirees that have that benefit, they have coverage for their spouse and dependents. So the comparable Living Well PPO Family Parent Plus and couple would be options for, would be the contribution plans as they were this year for that group of individuals. Tobacco use fee is still at the $40 for the single level and $80 for the other levels. They also recommended continuing allowing the embedded HRA, and that's because there is a family CDHP plan that has a embedded HRA that is really something that families like. A lot of retirees and state employees are in that plan. Sherry wrote down one more to go over the Living Well Promise. The Living Well Promise still continues. And next year they would need to complete the biometric, well, not the biometric, the health assessment online with Castlight, the vendor, between January 1 through July 1. If they don't, they're going to have that $40 fee to pay every month for the next year. So like in 2025, there's the people that didn't complete the promise would be paying the $40. If they complete it, they don't have to pay the $40. And we discussed the next option under number 2 was the default plan. Last year in 2024, the Living Well Basic CDHP was the plan chosen. And next year, the committee did have a choice between the Living Well Basic for this default plan or going to the high deductible plan. I believe the rationale that there are some things that high deductible plan does not allow access to, like the telehealth, some of the hinge health programs. So the committee decided to stay with the Living Well Basic CDH plan, P plan as the default plan that the retirees are allowed to enroll in if they fail to submit an application during as a new retiree or during open enrollments. Ms. Hampton has her hand up. Yes, ma'am, you have a question?
Yes, with the new high deductible plan, is there
Yes,
a
ma'am.
health savings plan also?
No,
Those-
no, it has no HRA. It has the high deductible and actually, well, the benefit, we can actually show you that benefit grid, but yeah, it's a few $1,000s. And then it's set to pay 70/30 after that high deductible, but no, it does not have the HRA. And that may be another reason because this Living Well Basic CDHP plan does have that embedded HRA. So as a default plan, the committee felt that other new plan would not serve the same purpose. And it is actually, as I said, the same plan you all had all chosen for 2024, and the price is not any different premium for next year.
Um,
So the
Connie, with that, should there be, or in your experience, should there be a health savings plan so that, I mean, when I look
Well-
at somebody that's going to have to pay $2,000 and then 30%, that's a lot.
I can't speak for the legislators, but I will take the thoughts around having a plan like that because you have a huge population with the state of young, healthy individuals in your risk pool. So what the rationale would be, someone like that may not go to the doctor at all, just do one physical. They would pay that, it would be from the deductible, so they would get somewhat of a discount in meeting that out of pocket. They get a discount through the insurance company and the provider. You know, there's a smaller discount than if they were paying on their own. So it allows that, and then it has coverage if something catastrophic happens and they end up, for example, in a large illness, then that's going to provide that coverage. So other than that, that's the thought around a high deductible plan such as that you're offering to a general population would be my only rationale. But they look at that and that's what they chose. They will present all of that to the legislators on the 16th for approval. And usually they go ahead with those recommendations and put them on into law at that time because I believe they're seeking a reg when they do that for this plan. So to speak to that design, no, I don't think it needs anything else because they give a choice of plans. So I feel like in there that gives the individuals a option to look at to what fits their needs best. So it's just, and I don't expect a lot of people to select that plan. The Department of Employee Insurance is not defaulting new employees as they have in the past. The Affordable Care Act did away with some of that, but the committee wanted to keep that benefit because of the way retirees actually have, a new retiree can enroll in a plan, and the first month they're in an insurance plan, they have an option to change it to a different plan if they don't like that plan. If we didn't default them into a plan, they would not be able to take advantage of that. And that's one of the reasons the Department of Employee Insurance is allowing us to continue with the default process. So that is beneficial for our retirees to take that look and have that option.
Okay, thank you.
You're welcome. One other than the default plan, Sherry, can you roll down to number 3? Number 3, the cross-reference is a unique benefit for the state of Kentucky, and they've researched across the nation. It is not something that's offered in other areas, states, or locales. It is something unique to Kentucky. It is in statute, but the Department of Employee Insurance is looking at that benefit and how it's structured. And so for next year, they're only going to allow cross-reference between individuals who select that option during open enrollment or that are on the cross-reference option in 2024 and roll over to 2025. There are about 600 people on the cross-reference option. I think that was just for September when payroll just ran. That take advantage of that. It can be two active state employees. It can be an active state employee and a retiree with us, or it can be two retirees on the Kentucky Employees Health Plan. So I wanted to make you aware they're changing that, and we will have to follow that guidance. So we are waiting for some more questions and answers from the Department of Employee Insurance, and we will post that for our retirees and make sure they know about it during the coming open enrollment so they can select the option during October. That, you know, if they wish to change their current plan, because it can only be a couple such as that, and on a family plan, that's the option that's offered in statute. The last is the Medicare Secondary Payer Plan. Those retirees, about 400 of them or so are on this benefit in this plan with the Department of Employee Insurance. And the premium is not any different. Their utilization is not any different. So this bullet is here to continue that plan, even though it is in statute and defined for DEI to do this, as well as us, the legislators put that in place. But what we have to do, DEI also had them put in there, is the premium could be a little different based on how they utilize the plan. So looking at all of those benefits I've just presented, do you have any questions? Or at this point, I think you could approve the recommendations for the Kentucky Employees Health Plan if you choose to do that, Dr. Miller. Unless y'all have questions of me.
Connie, you're calling it the a Medicare gap or Medicare
Secondary
we are
payer.
talking. We are talking about the Humana plan, right?
No, we are
Okay.
talking about the Kentucky Employees Health Plan
Okay.
that our Medicare eligible retirees have to be enrolled in order for Medicare to pay secondary and Anthem pays primary. Humana cannot enroll them because of federal law. When they return to work and they're Medicare eligible and they return to work with a participating agency, we cannot offer them Medicare primary plans. So the
Okay.
legislators have set this plan up, which is the same plan that the state employees are on, as well as the early retirees, but it works different behind the scenes. See, that's the complicated part. They have to pay with Anthem as primary and Medicare as secondary, or it's we're not in compliance with federal law. And they're aware of this, and Anthem's aware of this, and we have indicators that go over data-wise to ensure that occurs on these claims. And if it doesn't, they call us, the retirees, and we get it straightened out. So there's
Okay.
always that option.
We're gonna come out with two motions on this, but it's fairly complicated. Dr. Miller, I understand what you said about having Connie explain. So why don't we go ahead and make a motion to accept the Kentucky Employee Health Plan. So is there if there's someone like to make a motion?
I'll make that motion.
I'll second that.
Thank you very much. And then all those in favor, please say aye.
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 All opposed? The motion is adopted. Thank you very much. So Connie, now into the Humana.
I apologize. My allergies were getting the better of me this morning.
You live in Kentucky.
Yes, ma'am. Okay, the Medicare eligible, I hope is a little less confusing. This is the Humana plans. So the first bullet, similar to last year, because the medical only plan is the one that costs the most. That's our self-insured plan. The rate is set, the premium is set by GRS, our actuaries. So that premium is for 2025, $191.95. So that would be the contribution rate for someone at 100% contribution that were hired prior to the 7/1/2003 date and have 240 months of service credit. And saying that, the committee set that they went ahead and set the contribution rate for the premium plan at the 144.91. So that premium would be paid under the 100% contribution for 240 months of service credit or greater. And the essential plan has no premium for next year, so it's free to retirees and free to the trust. So I want to see if you have any questions on those before we get to this last bullet, which is more confusing. Any questions around the medical only, the Medicare Advantage premium, or the Medicare Advantage essential? No benefits are changing again, except might get Humana to just at the end explain some changes around the retiree out-of-pocket drug costs, which is a positive change for them at the point of sale. So if I have no questions there, this last bullet is a lot of language around a small group of people who have the exception plan or the the Medicare Advantage Mirror Premium Plan, the Medicare Advantage Mirror Essential Plan. Because those plans have a self-insured medical benefit, usually the retiree, it's not a plan they can select, but the mirror plans allow for them to get Part B enrollment from Medicare in order to establish enrollment in a Medicare Advantage plan. Because without Medicare Part B, doctor's visits and Part B services are paid by the retiree, with the plan paying like the 20% that Medicare normally doesn't pay. So the premium on that plan, because they don't have Part B, is the $341.90. And the Medicare Advantage Mirror plans includes the dental plan, and that admin fee is $529. So the total is $346.88. This year it was around $40 cheaper. In the Medicare Advantage Essential Plan would be $207.98. There's around 90 people in these plans. It's to give them a benefit that offers drug coverage when they can't get enrolled in the Medicare Advantage plan because they failed to enroll in Medicare Part B. So it gives them time to get that benefit, and then they transition to the Medicare Advantage plan when they establish their Part B enrollment. Is there any questions around that? So the other part of the exception mirror plan is there's a couple of people, for example, they already have transplant care underway at a facility that won't take Humana. Or they're under treatment with a specialist that won't take Humana. So on those individuals, those two are put on the mirror plan with an exception, and they pay the regular premium, and KPPA Trust picks up the extra, that one, like the $154.93. So like I said, it's for those bullets, the last two bullets, those two people, or right now there's two. There used to be one other years ago when somebody with end-stage renal disease wasn't allowed on their MA plan. So we worked through that, and these two people probably will stay on a little longer than the rest of the mirror plan because of their treatment. Is there any questions around the mirror plan?
Okay. Connie or Crystal,
Yes,
do you either one of you have anything else to say before we take a final motion?
Jerry, I think there's another page. Thank you, Mr.
Okay. Great.
That's just about, it's the setting the default plan. And the committee recommends it be the medical only, as has been in past years. That's all, Dr. Miller, that I have. Other than, you want to vote before or after you hear Humana, I want them to talk about that the IRA and how it impacts the retirees out-of-pocket costs and the smoothing impact of their prescription drug. Those are two new benefits that they have for this plan retirees. and they're not optional, they're mandatory by Medicare. So that's just part of the reason the premium went up a little, was the IRA. Actually, I think that's the main reason their premium went up on the Medicare Advantage plans.
Sounds like you're recommending that we hear from Humana, so.
Either before or after the vote. I think so your constituents can all hear, the retirees that are listening can hear that, and the other board did want to hear that. So I thought maybe I would offer to you as well.
Sounds good. Who's on from Humana?
I believe Larry is our speaker for Humana.
Yeah, good morning. Hey, it's Larry Lowe. Can you all hear me okay?
Yes.
Yeah, thanks for letting me take a few minutes. The Inflation Reduction Act that was passed a couple of years back does have a very significant remodeling, so to speak, of the Part D prescription drug benefit beginning in 2025. Currently, there is an $8,000 out-of-pocket maximum. So the most any individual member would pay in one plan year towards their prescription drugs would be $8,000. That, as a result of the IRA, is reduced to $2,000 starting in 2025. And really, it also changes the calculation as to how you get up to the $2,000 in the member's favor. So you will have members, many of your constituents, who will pay much less than $2,000, at which point their out-of-pocket expenses towards any future prescription drugs for that year would end. So it is a very significant change. There are a lot of operational changes that we are having to account for to get ready for 2025. But it is a big positive change for your membership. And, it was the major factor contributing to the rate action that was needed for next year. That legislation also allowed for or requires what they're calling the Medicare Prescription Payment Program, or M3P. That will allow a participant to not pay for their prescription at the point of sale, but rather they will be given the option to enroll in this program that will allow them to smooth that cost over the course of the remaining months of the year. So, for example, if they went in on January 1st and they were asked for a $100 copayment, they will be given the option by the pharmacy to enroll in this program. They will then get a bill from Humana that will spread that cost over the remaining months of the year. So that is an administrative function that we will play, that we don't anticipate a lot of members enrolling in, but they will be given that option starting in 2025. So in general, big changes to the drug benefit, to the benefit of your member. It's positive for the participant, and we're happy to answer any questions about that or anything else related to the Humana plans if you'd like.
Thank you, Mr. Lowe. I think we're ready for a vote, Dr. Miller.
Okay, are there any questions? There's been a lot of materials. Any questions? Okay, with that, I'd like to have a motion to accept the recommendations of the Retirement Health Committee for the 2025 Humana Medicare plan.
I'll make that motion, Lynn.
Okay, thank you,
Second.
Dr. Miller. Thank you, Keith. All those in favor?
Aye.
Aye.
Aye. Opposed? The motion is adopted. And Dr. Miller, Connie, everybody, thank you for a lot of hard work to get to this. And it does sound very positive for our membership.
Thank you.
Okay, the next item on the agenda is the quarterly financial reports. And Mike, are you going to take that?
Yes, ma'am. Good morning, everyone. Starting on page 13, this is the June 30 financials. I wanted to discuss first the new presentation of the quarterlies. So with the decision to have two separate ACFRs, one for the CERS system and one for the KRS systems, we've transitioned the presentation of the quarterlies to how the ACFRs will look as well. So what you have in front of you is a kind of a comprehensive statement of the fiduciary net position. It combines the pension and the insurance plans and gives you a KRS total. That KRS total is what our external auditors will be giving an opinion on. In the past, the ACFR opinion was on the KPPA total, but since we are not combining C and the K plans anymore, we won't have a KPPA financial statement. In addition, the statements you'll see today have actually been modified even further. We've combined some line items, and I'll talk a little bit about that on the statement of changes. But for this one, the only thing that I want to point out that'll be different in the ACFR is there's a comparative year, 2023. Since we didn't have separate ACFRs last year, we don't really have an audited C total or K total. And so our financial statements in this year's ACFRs will not have a comparative total in the basic opinionated financial statements. And of course, all of the notes and comments will not be included in the ACFR. But if we want to go on to page 14, and if you look in the bottom, near the bottom of that, you can see the KRS total for 2024 is $8.6 billion. And that's $1.2 billion or 15.9% higher than the net position at the end of 2023. This is driven, if we page up, back up to the investments by the 29.48% or $1.8 billion increase in total investments at fair value. All asset classes except for derivatives have had an increase year over year. If you just look at the pension plans by themselves, the 3.9 billion for KERS, 981 million for K hazardous, and 618 million for SPRS. They've increased 17.21% or 878 million. The three insurance plans have also increased 303 million or 13.03%. We have various notes on the bottom of this statement that you can look at your leisure. And then I want to go ahead and move on to page 15 and 15 and 16. So if we go down to near the bottom of page 16, you can see the KRS total 2024 right above that blue line. There's $1.1 billion compared to 870 million in the prior year. So that's basically the net increase in fiduciary net position. And it's driven again by a slight increase in contributions as well as 235 million or 43.5% increase in the net investment income. The net increase for the three pension plans is 303 million, and that's, well, it's 303 million this year. That's an increase of $86 million or 39% higher than the prior year's total. The three insurance plans total 304 million, and that's 86 million or 39.49% higher than the prior year. And we can analyze that a little better in the contribution reports, which begin on page 17. So if you look at the yellow line, the net contributions, you can see that they're positive for all three pension plans. 446.8 million is the one for K non-hazardous. The member and employer contributions for each plan are up, while the AALC and the general fund appropriations remained flat. Total outflows were slightly elevated across all three plans. If we do remove the net investment income of 112.4, 26.1, and 18.7, we can see in the bottom chart that all three plans have positive net cash flow for the period. The insurance statements are right below that. The contribution statements for insurance. They show the three plans reported net contributions of 103.3 million, minus 0.2 million, and 5 million respectively. If we remove the net investment income out of these three plans, there's a negative cash flow there's positive cash flow for the K non-hazardous of 60 million, negative of 15.9 million for the hazardous plan, and negative 1.5 million for the state police plan. Any questions on those statements or contribution reports? Okay. I believe the next page are outstanding invoices for the K systems as of 6/30/2024. If you look at the type, again, the AALC is $4.4 million. That's outstanding. That's mostly related to one employer that's in litigation. The grand total is 6.9 million, and that's a little bit less than the total was at 3/31/2004. Again, the bulk of that total $6.9 million outstanding is the AALC. These are the top employers that make up that total. The one that's in litigation is on top, and then we have the Department of Highways within the system is a little bit higher than usual, but we expect that to be collected somewhat soon. The next chart shows us the monthly reporting invoices that were late, and then the related waivers for them. So we had 3 past due invoices that were paid. We didn't issue any penalty invoices for the K employers during the month, except for one that was waived for the master commissioner. And now the next page is admin budget. And so this is the summary. My comments are at a summary level are in the line items below. So this is as of 6/30/2024, comparing total admin budget to last year's expenditures in the admin budget. I will let you read those comments on your own, but if Sherry will page down to near the bottom of page, I think it's 22.
My question
Yeah.
on the payroll being over budget, did we take this into account when we approved the 25 budget? Are we going to look at it as
Yes, the 2025 admin budget that the board approved back in June incorporates the higher salaries that are in place, and as well as a contingent for an increased headcount that's being worked on with the budget office this quarter.
Okay, thank you.
So if you look at that subtotal right above the reserve line item, that is basically our total expenses for the year. It was $44.1 million. That's $1.4 million below budget. That means we did not need to spend any of the $4.8 million reserve amount that had been unallocated. Our overall admin costs for the fiscal year were 7.71% or $3.1 million higher than the total admin costs of the prior year. This hybrid chart right below shows the breakout of those costs. So that 44.1 million among the 5 pension plans based on the hybrid percentage. However, at year end, if you go down, we have to adjust those costs for plan specific costs as well as separation costs. And so that we took that $44.1 million, took some of that cost out of the 5 pension plans and added it back based on whether it was plan specific or separation. This is the last year that C is being charged for separation costs. So that line item will go away in the future. And the charts right below that are the Chase charts that show JP Morgan fees and hard dollar interest earned by month during the fiscal year. That's the quarterly financials.
And are these the numbers that are going to be audited? Or are you still working on this?
Yes, these are the initial numbers that were provided to our externals for admin costs during the fiscal year. Yes, as well as all of the other financial statements for investments, cash, liabilities, etc.
Thank you. Good year.
If there's nothing else, I'm also the next topic. So
Standing employer invoices.
yeah, so back in early 2023, we had a request from the Finance Committee to address and do some research on outstanding employer invoices. And so we've done that. We formed a team, and that team has come up with 8 little categories where interest can or cannot be charged, and some research related to that. We plan on presenting a final memo to the KPPA board asking for these recommendations related to these 8 categories. What I want to speak about here is there are lots of in those 8 categories, there's a lot of detail in the appendix, but what we've concluded is in certain circumstances, we can charge interest for an employer reporting late or other categories of contributions that are due. We can charge interest in some of those cases. Once that interest has been charged and it's due and payable from the employer, there's very little statutory authority that allows us to charge interest on the interest invoice or interest on the invoice that was created and then becomes past due. So based on that, I want to touch base a little bit on the recommendations that we're going to present to the KPPA board. We also noted that when we do charge interest, it's at an actuarial rate that's been adopted by the boards at 7.5%. And so we recommend that we continue to use that 7.5% interest rate that's currently in place until the boards approve something different. And then we want the KPPA board to authorize staff to create a comprehensive regulation related to employer interest based on all of this research that we've done so that it can be codified in a regulation and applied consistently. And then we've made some recommendations within the 8 categories above, and so they're summarized there. And some of them we're not changing any processes. Some of them we're doing something just a little bit different, and that's the recommendations we're going to make to the KPPA board. The one item I wanted to point out in more detail is this standard monthly contribution. So as most of you know, employers are required by statute to report and pay contributions to the systems by the 10th of the following month. And if they don't do that, they're subject to a penalty or an interest, and the interest calculation is not to be less than $1,000. And so we recommend we continue to do that. And there is a process in place where we can waive that interest invoice for various reasons. And so we want to keep that policy in place and allow our KPPA staff to waive those for employers when applicable and appropriate. What's outstanding on these $1,000 invoices are mostly small employers who they've paid the contributions. They were just late paying the contributions. So in all of the cases that I've looked at, these outstanding invoices that are for penalties are still outstanding, but the contributions related to them have been paid. And some of these invoices go back a long time. And we would be able to charge interest every month that payment, that monthly contribution wasn't paid. But we're recommending we don't do that because, again, most of the employers who are late that have the capacity to pay the penalty or interest pay them. It's the smaller employers that struggle. And if you look a little bit further down, if I can ask Sherry to page down, I think it's page 29. These are the list of, as of 7/31, of outstanding penalty invoices for late reporting. And as you can see, most of them are very small amounts, and they are for smaller employers. So to charge every month that they've been late, I think would be an additional burden on those employers. So we're recommending we don't change the current process that we have in place related to those penalty invoices.
But they are charged $1,000, is that correct?
Minimum, yeah. So if they owed, if their contributions were, say over $2 million, you would calculate 7.5% interest charge for that, and it may be $1,000. But if their calculation is, comes up to, if they only owe $100,000 in contributions, then, a 7.5% may only be $200 or $300. They're charged a minimum of $1,000.
Yeah. That sort of takes care of that small contribution.
The other thing that we're hoping to do is after we kind of get these 8 categories approved and then try to get them into a regulation. In the meantime, we do need to form a group to look at all of the old invoices and kind of make some recommendations on what to do about them, right? Do we pursue them legally? Do we bring some of them forward to the board for action? Most of these employers are actually C employers for the most part that have past due amounts, but there are some significant K ones as well. So that's the update on employer interest on past due invoices.
Thank you, Mike. And also John is working with Mike on that and has, I'm sure that's appreciated by Mike.
Yes, John is very helpful.
Okay, are there any questions? There's been a lot of material and we're talking about year end. Any questions on the financials or on the invoices? Okay, there's no motion. So the next item on the agenda is the investment committee report. And Pruitt.
Yes, I'm going to turn it over to Steve, but basically we have a recommendation here that is possibly well, let me just back up. We have a recommendation for adding to an investment with a group that's been on our team and investing for us for a number of years, but it's going to change the nature of it just a little bit. And I'll let Steve go into the recommendation, but I think it's been very successful for us, and we don't really want to have to give it up. And there is a method that we can do to keep this money at work, and also it fits the need to add a difficult need to fulfill is in the real return area. So, and this does fit that category. So, Steve, you want to take over?
Yes, thank you. Thank you very much, Mr. Lane, and appreciate everyone's time. Before we get into the recommendation, if you don't mind, I'd like to briefly highlight a few items that were noted in Mr. Lane's memo, as well as some items that were covered in the investment committee meeting. So Sherry, if you go to page 39, please. And this is really where we're looking at the final quarter and fiscal year 2024 performance, and I just wanted to highlight a few things. For the quarter, the pension composite returned 1.17%, while the insurance composite returned 1.25%, with individual portfolio performance ranging from 106 basis points to 1.34% for the quarter, and underperforming the benchmark by between 86 and 118 basis points. For the fiscal year, all of the portfolios performed well, with the pension composite returning 9.80% and the insurance composite returning 11.08% for the fiscal year. And really, despite this strong performance, the pension composite underperformed the benchmark by 71 basis points, and the insurance composite underperformed its benchmark by 132 basis points for the year. During the investment committee meeting, we had a very robust discussion on the drivers of performance and attribution and the underperformance relative to the benchmark, which were really driven by two factors we've discussed at length in the past, but we had a presentation on both at the investment committee meeting, and I just wanted to touch on a few of those. For the year, the private equity portfolio underperformed its public equity benchmark, which again is the Russell 3000 plus 3% lagged one quarter. It's a lot of words, but it's a public markets benchmark plus a 3% bogey and then lagged one quarter. And our portfolio, our private equity portfolio, underperformed that benchmark by over 28.5% for the year. So substantial underperformance, and it wasn't specific to our private equity investments. This was consistent with private equity, the overall market's performance relative to public equities. As we know, public equities had especially for the year ending March 31st, which this benchmark was for that period of time, really had a stellar year. So this accounted for between 175 and 200 basis points of underperformance at the total fund level. And again, we go back for the year, we underperformed by 71 or 132 basis points. So that more than accounted for all of the underperformance. And then while the public equity portfolio produced a return of 17.01% for the year, it trailed the benchmark by 237 basis points, which accounted for between 60 and 100 basis points of underperformance at the total fund level. And the portfolio's underperformance was attributable really to that, we've talked about this in the past, kind of that narrow breadth of performance in the public equity markets driven by mega cap technology stocks, with only a handful of individual stocks accounting for about 70% of the overall performance of the index. So it's very concentrated. And our portfolios by design, as we discussed, are much more diversified, with significantly less concentration risk than is exhibited by that broad market public equity portfolio. So while a number of those stocks are very large cap, and they contributed the majority of performance, our public equity portfolio is much more diversified with less concentration risks. I would also note for the fiscal year, the core fixed income and specialty credit portfolios performed very well, outpacing their benchmarks by 246 and 109 basis points respectively, which contributed between 50 and 100 basis points of outperformance at the total fund level. So, kind of based on our overall asset allocation and attribution, obviously the vast majority of that underperformance, or in fact more than the stated underperformance, was driven by that mismatch in private equity with the benchmark, and then the narrow breadth in our public equity portfolio failing to keep pace with the performance of those mega cap technology stocks. All of the portfolios have continued to produce top decile or top quartile risk-adjusted performance over 3 and 5 year periods. That's something we're very proud of. And we really think that demonstrates the efficiency of their construction and management. July performance was recently finalized and released, and the portfolios are off to a strong start to the new fiscal year, up between 162 and 190 basis points for the month, and outperforming the benchmark by between 70 and 90 basis points. As we noted in the meeting, public equity portfolio for the month of July outperformed and made up some of the ground that was lost in the last quarter of the fiscal year, returning 2.33% for the month compared to a benchmark return of 1.61. So about 70 basis points of outperformance in our public equity portfolio. As we know, July, we saw some rotation out of that mega cap tech. And so we saw a broadening of the performance of the public equity markets, which benefited our portfolios. August performance is still very preliminary, but the portfolios had another strong month and looked to be up about 150 basis points for the month. So a strong start to the new fiscal year. Very quickly, a couple other highlights. Sherry, page 39, please. This was a new page that we put together for the investment committee meetings, and it really is looking at the internal portfolios. Sorry, Sherry, that might be the wrong page. The internal portfolios, and we provided an update on these passively managed portfolios and the proxy portfolios. And despite the elevated market volatility, the portfolios have performed in line with expectations and consistent with their mandates. From a compliance perspective, we noted that there were no issues to report as not in compliance as of the end of the fiscal year, and all of the individual asset class allocations were within their IPS specified ranges, with the majority within 150 basis points of their target allocation. So we took, over the course of the last half of the fiscal year, since the adoption of the new IPS allocation targets, we've been rebalancing as market opportunities are presented, and we've moved all of the asset allocations closer to their IPS specified targets. For the investment budget, we noted that for the fiscal year, investment fees and expenses were $34.7 million, more than in fiscal 2023, but $28 million less than in fiscal 2022 and in line with fiscal 2021. Focusing just on the investment advisory fees, which are the base fees for the systems that we pay to external investment managers, I would note the consistency across time with only a 13% increase in fees since 2021. despite a 20% increase in total assets. I would also highlight the reduction in core fixed income investment advisory fees of $350,000 for the fiscal year, and that's despite a 25% increase in market value, which was driven by the rebalancing of the portfolio, including bringing a sleeve of the portfolio in-house, which ultimately we expect to reduce fees by $1.5 to $2 million per year. We also noted that the effective rate, this was a question that had been asked a couple investment committees before, the effective rate of management fees for both the KRS and the SPRS pension portfolios is about 29 basis points. So we think that is institutional quality fees. We work very hard to keep those as low as possible. Specifically for asset classes, core fixed income is about 7 basis points, public equity about 16, specialty credit 53, real estate 77, and private equity 47. And for fiscal 2024, an effective rate of 46 basis points, which is inclusive of the performance-based fees. I'll pause there with questions before we jump into, as Pruitt mentioned, the real asset investment recommendation that was made at the investment committee meeting.
Are there questions of Steve at this point?
Yes.
Steve, yes,
Yes.
Mary?
Yes, Steve, where does that put us of the ones that were lagging the benchmark? Are we in the lower 25 percentile, between 25% and 50%? Can you give us some perspective of how bad we were lagging compared to other?
So for the private equity specifically, which was the significant underperformer relative to benchmark for the fiscal year, our private equity portfolio was in line with broad private equity investments. It's a pretty broad space, and one of the issues that we noted in the investment committee meeting is there's definitely a vintage year bias to private equity investment. And for a number of our plans, there was a funding hiatus. So there was a period of time when there were liquidity concerns, and given the illiquid nature of our private equity investments, a number of plans didn't participate in new investments. So we have really older private equity investments. But if I look at the broad market, private equity performed somewhere between 4 and 8% for the year. So our private equity investments were in line with the broad private equity market. So certainly not out of line. I think Wilshire can weigh in as well, but the nature of the markets in fiscal 2024, we have this private equity portfolio and a public equity benchmark, which is not unique to pension plans. I think there's a struggle that was discussed at the investment committee meeting. There's a number of different ways that pension plans benchmark their private equity portfolios, and there's benefits and drawbacks to the different methodologies. What we use currently is that Russell 3000, so a broad public market index plus a 3%. So that's more of a performance objective. Over the long term, over the life cycle of our private equity investments, our expectations are we're going to outperform broad public equities by 3. And that's kind of what we're getting paid for that illiquidity of those private equity investments. But that underperformance of our specific portfolio relative to the benchmark was something we saw across many public pension plans. It was a period when active management was struggled to outperform, and plans struggled to outperform public equity benchmarks. So we weren't unique. If we look at the Tux universe, which is the Wilshire universe, or a number of different providers that provide kind of benchmarking for pension plans, I think the fiscal year returns ranged anywhere from 9 to 10.5%, kind of on average. So we were in line, especially given the KRS and the SPRS lower overall risk profiles. And I think we see that in some of the peer reports that were provided by Wilshire. So we tended to be middle of the pack-ish for the fiscal year. But again, our risk reward, so our Sharpe ratios, our top decile or top quartile, so that risk-adjusted performance tends to show very well in the peer universe.
Thank you. That's helpful.
Yes.
And Steve, I'll just jump in. Wilshire is having the very similar conversations that we're having right now. When a client uses a public benchmark as a benchmark for their private equity portfolio, in times of extreme performance, to the positive or the negative, it can show up as an extreme over or under performance to that benchmark because of the way the private markets have lagged performance. Their marks are not current. So in 2022, when public equity markets were very negative, your private equity performance would have looked very positive just simply because they were not being marked down as the public equity drawdown as well. So this is not uncommon. We're having very similar conversations, and everything that Steve said is absolutely correct.
Is there such a thing as breaking those into public private equity and private equity? I mean, if I would assume that there's a lot of money in pension plans, governmental pension plans, not for whoever creates the indexes. Is there any discussion on that?
So private markets benchmarking has been an imperfect practice for quite a long time. There are different methods you can go about looking at benchmarking your private markets portfolio, which we're happy to go into. Maybe this is not the right forum, but we do have materials that we can share with you on that. The benchmark is what it is right now, which is the Russell plus 3% on a 1 quarter lagged basis. Other areas that we can look at, you can look at IRRs. We can look at also the like a Preqin index, which is really looking at then a universe of different investments to provide you with actual return distributions for that point. And they generally will use a median as that index level. Those can be helpful in short period term times as a data point. So we can certainly look at potentially providing that context within a performance report so that you can have both your actual IPS benchmark, which is the Russell 3000 plus 3% lagged 1 quarter, as well as having some universe comparison so you can see how you're stacking up in short-term periods versus that benchmark when there is extreme market performance that might be throwing off your IPS benchmark.
Yeah, I think this is a very worthwhile discussion, and obviously when an ongoing one we've had with Wilshire, it's an imperfect, and I don't think, as Wilshire mentioned, there's no real consensus on the best. I think a lot of boards and investment committees will pick a public markets benchmark because it's easy to understand. It's public. There's no gaming to it. The difficulty with some of the privates are both it tends to be imperfect information. There can be a bias as to the universe, and then establishing a comparable universe for our specific program is difficult because of the breadth of what constitutes a lot of private markets on the private equity side. So I think there's something we can do there, and a little context. Prior to the last revision to the IPS, we actually utilized a dual benchmark, and that was a short-term benchmark, which was the actual performance of the private equity portfolio. So if our private equity portfolio returned 4%, the benchmark used for periods of less than 5 years was also 4%. That doesn't necessarily give you a lot of information on how the relative performance of our portfolio is doing over the shorter term. Then over the longer term, we use what we're currently using. So periods longer than 5 years, that Russell, a broad public equity benchmark plus a bogey of 3%, which again, I go back to that's kind of the objective of, I think, a private equity program is over the longer period, over full cycles of the investments. Remember, most of these are very long term. In fact, our private equity portfolio has investments, some tail investments that are I think Anthony said old enough to drink. So we have some older vintage private equity investments. They can have a very long lifespan. So over that entire period, our expectations or our objectives are that they're going to outperform public equities by more than 3%, given the illiquidity premium that we hope to achieve in those investments. But over the shorter period is as Wilshire mentioned, that there can be a lot of volatility. And optically, it looks like there's significant underperformance, but that's only relative to an asset class that's very different, has very different characteristics than our portfolio.
Well,
Steve,
then
is there
there's
any,
another-
is there any other asset class that has the same issues?
So anything that's private, so if we look at private credit, if we look at to some extent at real estate as well, they probably have there's been a little more work maybe done on and maybe a little more uniformity in the asset class that allows there's some index providers. So for our specialty credit allocation, we're using a blended public equities benchmark, even though we're investing in private credit as well. But there are some other, we've talked about that benchmarking as well. There are some alternatives in specifically the private credit space that I think could be useful comparisons.
Okay, thank you. Are there other questions? Okay,
Yeah,
Pruitt.
I have a comment. We get into this discussion and we treat the private investments as if they should be compared to public. And let me give you an example. The Wilshire 3000 is 3,000 stocks, or roughly 3,000, and they're priced publicly at the end of every day, at the end of every quarter. And the pricing in the private equity market is always trailing, and is while they take it seriously and they use our managers use third parties, no one really knows what these investments are truly worth until they're sold, till they're exited. And where that's very different with the public markets, and this goes back to some comments made earlier. In a bull market, the Wilshire goes up. Private equity doesn't go up necessarily till those investments are exited. So it's a little risky, I think, to be evaluating on a short-term basis and the success or not success of a private equity program. But what we've tried to do here is create some benchmark and then only really consider it as in a longer term manner.
Thank you. Other questions? Okay, I think we're on to the do investment discussion. Pruitt, are you doing that, or Steve?
Well, I'll just introduce this, as I said earlier, this is an investment that we've actually had in our portfolio in a slightly different format. And it's been very successful for us. We want to keep it, but we do need to kind of shift the format under which it is held and structured. So I'll let Steve pick up on the details on this. And unfortunately, Anthony, who did a lot of the homework on this and always has, as a child he's got to take care of today.
Yeah, thank you, Pruitt. And yes, unfortunately, Anthony can't. I don't think he's going to be able to join us today. And this is his asset class, but I will do my best to cover it. So, the investment committee unanimously approved staff's recommendation to invest up to $35 million in what is being called the Project Spurs. It's a continuation vehicle managed by Strategic Value Partners, and that's obviously pending successful legal negotiations. If you turn forward one page, please, Sherry. Thank you. SVP has successfully managed assets, as Pruitt mentioned, for KRS for almost a decade and currently manages over 150 million across the systems. Our view is this is a unique investment opportunity in a scarce, hard to replicate asset class or asset with defensive characteristics that will be part of the real return asset allocation and will be shared among all KERS and SPRS funds. When fully funded, this investment would represent approximately 35 basis points of total fund assets and we would anticipate funding with existing cash or the unwinding of existing proxy positions. A little history: for several years, KERS and SPRS portfolios maintained a structural underweight to the real return asset class, as there was a lack of compelling investment opportunities, especially on a risk-return basis compared to other asset classes. As the market has shifted over the last 2 years, the opportunity set has expanded, and the relative risk return of a number of real return investments have become more attractive. As you're aware, over the past several quarters, staff has been active sourcing and reviewing real return investment opportunities. And we look for investments with compelling economics, favorable standalone risk-adjusted returns, low return correlations to current real return investments and the broader overall portfolio, investments that provide inflation sensitivity and meaningful diversification during periods of inflation, and also provide yields and current income, often from contractual cash flow streams. So we think that this investment opportunity ticks all of the boxes. This Spurs, Project Spurs, is a 9% position in the current Strategic Value Special Situations Fund 4. It's a 2017 vintage fund with $2.85 billion of committed capital, which includes $65 million from KPPA, which was less than the approved $75 million at the time because the fund was oversubscribed. The asset itself is a toll road. It's a 45-mile-long toll road in Texas between Austin and San Antonio. SVP acquired directly from lenders in 2017 following a restructuring. And today, the firm controls 65% of the asset, with the remainder held by the U.S. Department of Transportation through its Build America program. And specifically for this vehicle, SVP is creating what's called a continuation vehicle. And this structure is there, as opposed to going out, as we typically see in these types of funds, and selling the assets and having a realization. What they're doing is they're selling it to a continuation vehicle. And the reason they're doing that is, SVP has owned the asset for several years, and they see compelling value and opportunity in continuing to own the asset. And it's well positioned for the growth because of Texas's continuing economic expansion. And so the realization of additional value is expected in the life of the asset. So they think it's more one of those investments that they think it's better to hold here. There's also an alignment of interest. So SVP, the general partners, not only are rolling their existing interest in the asset, but they're also adding additional personal capital. So the general partners themselves are adding additional capital to this new CV structure. From the standpoint of the vehicle itself, it's a term of 8 years with 3 one-year extensions, 2 at the GP's discretion and 1 with advisory committee consent. Management fee is going to be 1% on invested cost. Plus there's a profit sharing or performance-based fees that are scaled based on what the actual performance, realized performance is. 10% on above a 10% compounded annual return, 12.5% over 12.5% compounded annual return, and 20% over a 15% compounded return. So the fee basis for this vehicle is actually less than what we are in the current vehicle. And as Pruitt mentioned, kind of given the difficult nature of the real return asset landscape, we've looked at a number of different both asset class, sub-asset classes, as well as structures. As you're aware, we've committed capital to farms, to barge leasing, and to sports partnerships most recently. And we think this is really a compelling case that meets all of our criteria for what we think is appropriate in a real return space. We're sizing it, given the nature of the assets, not as large as our recent commitments in the real return space, but we think appropriate that it's meaningful capital. It'll have a positive impact on overall performance. It has a low correlation both to the existing assets in our real return allocation, as well as to our broader portfolio, specifically public bonds and public equity. So it should have a very low correlation. Given the nature of the cash flows and the asset itself, it's going to have a high degree of inflation sensitivity with contracted cash flows. SVP has done a very successful job of managing this asset over the life of their ownership. And with the plan for the expansion, there's a rail expansion, a spur expansion that is in process. And with the realization of that, they expect valuations to continue to increase. So base case for us, we're looking for high single digits, but we figure if the value is unlocked, with the plan that SVP has for the vehicle, that we could see returns in excess of kind of our base case. So we think it's a great opportunity. Management at SVP, we view very highly. They've done a great job for the money they've managed with us. And the asset, we think, is a really unique opportunity. It's not something that comes along very often. The deck includes a number of comps that have been out there. They don't come around, like I said, that it's not an asset that comes to market very often. But the comps on where we have seen toll roads in the US puts this well in line. I would note that it's also being done at a modest concession, and that's typical of CV vehicles. So I'll pause there with any questions you might have.
With this investment, we were 8% of the original. Will we maintain 8%, or will that change?
So we haven't actually been allocated yet. So our interest is based on what we appropriated the size for the individual portfolio. So we're looking at about a 35 basis points to 40 basis points of exposure overall. We're likely to be a smaller percent of the overall Project Spurs CV vehicle than we are of the existing vehicle that it's in. So we'll be a smaller percentage. They have two large key investors that have already spoken for a significant amount of the new CV. So they have two anchor investors. And then, as I mentioned, SVP, the GP, is rolling their existing interest. So it will be a realization out of the fund we're currently invested in. So we'll get the proceeds. So the recommendation is to roll those proceeds essentially plus some additional capital into this new continuation vehicle.
Okay. And I have one other question on the Build
Sure.
America bonds. That's, if I'm not mistaken, that's debt. We called it ownership, but does it revert to ownership of the government once the debt's paid off?
So this is the acquisition was made through the Build America program. So it was they're going to maintain a 35% ownership. The U.S. Department of Transportation is going to maintain a 35% ownership in the asset.
Interesting. Thank you.
Sure.
Steve,
Yes.
do you know whether they collect the tolls electronically, or is there a person that collects the tolls, and do they send out bills for people that? And who does that?
It's collected through the Texas Department of Transportation. I believe that they're moving towards mainly automated tolls in Texas. I don't know specifically if they still have, a lot of them are that you have the unit in your vehicle, but there's still an individual that may collect for people that don't have the pass. But I know Texas has the passes, the fast passes. So I don't know what the breakdown is as far as how much is collected at point of toll or how much is collected through billing.
That's been a huge issue in our bridges here, the automation, or at least an aggravation. I don't know.
It's been a bumpy road. Texas has been doing it for a little bit longer. They hopefully have it worked out. I know there's I think the leakage SVP had one of the studies that was done on actually the firm that did the same study for our bridge on volume did mention leakage, and I think it's very small specifically for this road.
Yeah, this road is heavily trucks.
Yes.
Your I-35 is a a mess down there because of the overabundance of trucks on it. So, and the truck companies all have or well, not all, I'm sure, but virtually all have the electronic system, and they have a special lane to go through. So they don't have to stop. They don't like stopping.
Thank
Okay,
you.
are there any other questions? If there aren't any questions, we need to have a motion to ratify the investment committee's recommendation of investing up to 35 million in the SVPCV project Spurs.
That was
So
perfect.
is there a motion? When we make that motion?
I'll make that motion.
Thank you, Pruitt.
I'll second.
I think that was Dave. Thank you very much. Well, all those in favor, please say aye.
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 Opposed? The motion is adopted, and thank you all for all the hard work. I told Pruitt, I actually know all these companies because we had a toll road at the airport authority, and it's an interesting business.
Well, thank you very much. Appreciate everyone's time.
John, you want to give the CEO update?
Yeah, I can do that. Thank you. I guess my report has to do with activities since our last meeting. As was mentioned earlier, I provided some assistance to Mike in connection with the accounts receivable that the K systems have on their books to find out exactly what it is and what the receivables are for and that sort of thing. As we'll talk about in the closed section, I've been working a good bit on those issues that we will discuss. I would also mention that I attended the NASRA, National Association of State Retirement Administrators, one of their annual meetings. It was in Pittsburgh. Aaron, Rebecca, and Ryan attended the meeting as well. And there was a nice crowd of people from plans all over the country. Some of the things that that we struggle with, the other systems are struggling with as well. I would say that based on some of the concerns expressed by the other plans across the country, that we're doing better in some categories than they are. One has to do with our technology. People have bought systems, turnkey systems from from certain vendors. Ours, it continues to be updated internally, so that's a good thing. ESG reporting, environmental, social, and governance issues. We were ahead of the state legal requirement related to ESG, which says that we should invest based upon a common word used in these discussions, which is on the pecuniary interest. We are guessing how much money we're going to make, taking into account any risk from environment and other issues, but we're focused on making the money. Other states have some concerns that we don't have. Some states have made directives for divesting certain things like South Africa, Israel, Ukraine, Russia, also either investing in or not investing in oil and gas and coal sort of things. And we're not burdened by any of those divestiture issues. Everybody has capital market assumptions. Over the years, we at one point we had the lowest capital market assumption that we used to compute the retirement benefits. We had the lowest one in the country, but over the last few years, the trend has been for most capital market assumptions to come down so that we're more like those other states. One of the common issues is to find out when beneficiaries die. That's the end of the benefit. So we need to know that. We've got some pretty good information on that. And there's some struggling getting information from Social Security administrations that they're on death. They may have a better reporting system than the states do, but they're holding on to that information. Those are the highlights of the NASRA meeting. It's good to find out a few things that we need to do, and then a few things that we're doing well, and gives us confidence that we're moving in the right direction. So I'd entertain any questions on anything. That's the CEO report.
Any questions for John? John, thank you very much, and thanks for attending those meetings.
Yeah.
The next thing on the agenda is the approval of the calendar for next year, and these are the regular meetings. Special meetings can and are scheduled, but they have to be noticed differently. So I don't know that are there any questions on this? Hope it helps you with vacation planning.
Could we get a separate printable PDF of this? So I can stash it on my magnetically to my refrigerator?
Yes, absolutely. I will wait. I just wanted to wait until this is approved, and then I will send it all out to all of the trustees for you.
Thank you.
Thank you both. So is there a motion to approve the 2025 KRS Board and Committee meeting calendar?
So moved.
Thank you, William. Second?
I second.
Okay, thank you, Mary. All those in favor, please say aye.
Aye.
Opposed? Since there are no opposed, the motion is adopted. And thanks everybody very much. And Ryan, you're up now.
Well, thank you very much. I appreciate it, and good morning. Just wanted to touch on a few things that I've included more detail in the memo. Just starting out with some communication, obviously in a lot of communication with John and Ed, internally with the staff, and then just a commitment that I had made is to be available to board members, hopefully at a place convenient to you. Started in Central Kentucky. It's obviously optional, but always available, and was going to kind of reach out in the Louisville area next, and then hopefully get some that have a little farther to drive, when they're here for a meeting or other type of business. Some of the legislative meetings that Dave started during the transition have continued, and then also reaching out to some that I had relationships with, just to make sure we're in the best position for next session, future sessions, for communication. Also peers, we've met with the legislative, judicial, and teachers a couple of times. That's a relationship that I've had for quite a while. Aaron, Rebecca, and I have met a couple times with them. Some really good conversations, and Steve was in Frankfurt yesterday, and we met with their CIO, and I think those conversations continued on some investment strategy. They have interns that are remote, so there was just it was like operational and good discussions, I think, on the investment side. If you haven't seen it, we can resend it. We're going to do a poll for legislative tracking. I think it's a good opportunity in this short session, this 30-day session, to kind of solicit. We've had a process here at KPPA. I've had process for my 12 years in OFM on tracking. Just we're going to solicit. I had some say to me that, hey, there's just way too much information. Others say, I like this specific aspect of it, what's been done in the past, and just general ideas. So there's a couple more days there. We can extend it if need be. But we thought, collective group information would be better than just sitting down and duplicating the past, or, just making a few changes. We'd like to know if you use it even at all. The Louisville office, obviously, it's taken a while, but that's to be expected when you have to comply with the procurement statutes, and a very short-staffed Department of Facilities and Support Services in the finance cabinet. Basically, there is 3 locations, and there's drawings being put together for how the space would be laid out. I think the general philosophy here is, we want to get it right. We want the space for a long time. So there has been numerous back and forth on the drawing and positioning, size of rooms, locations, priorities for kind of the staff that Steve has for those that'll be using the space. John did a good job talking about the conference we attended. The only thing I might add there was some additional discussion that I've found interesting. I think everybody hears AI. It's not something that I think will be adopted here in state government immediately, but there's maybe some dipping your toe into it with some transcriptions of calls. And then also another thing that I thought would be interesting is AI can even monitor calls, and when there's, say, tension among the member, there can be automatically a supervisor grouped in, et cetera. So there's some just unique tools, and I think there's some discussion to have there that we started at that conference, and some of our peers are dipping their toes in. So definitely going to pay attention to that. Moving on to the rating agencies, it's been a long tradition. Dave was very kind. Gary Hardman was very kind when I would bring rating agencies to meet with them. We did Fitch originally, and actually this week we did Moody's. KPPA met with Moody's right behind the state budget director, and then they left for the governor's office. So there's a full court press, hopefully, for a Moody's upgrade, and that can only benefit us. If the state has a higher credit rating, cheaper cost of capital, that can only benefit us as taxpayers and KPPA. So good conversations with them. PPOB went well. The meeting, Aaron and I talked about the Inflation Reduction Act, which Connie talked a little bit about earlier, and the traditional information. The next meeting will be on the 24th, and then that morning we're going to present to state government. They've asked us essentially the same information that PPOB, but it's a different group of legislators. Moving to risk management, there's some discussion among the boards and various members kind of on, we're moving forward on the compliance officer, and just a broader risk management. Is it decentralized? Each manager is responsible. Is it centralized? So there's some training. So we went to the NASRA conference. The other major trade organization is NCPERS, and actually have some training on risk management. So Mike has experience with Toyota, and I have some experience as well. So we were going to attend that. And then I have a relationship with the risk manager at UK. So we just thought, hey, how do other large institutions in the state handle it? So he's offered to provide some research and assistance. Just the last 2 things, focus kind of internally within KPPA. We had 3 all employee meetings. They seemed to go very well. A lot of good discussion, and the main topic was KECC. So the state has rolled that out, and I think it's very beneficial for the charities. I mean, the video we saw really tugged at your heartstrings. It's very beneficial, but it's also beneficial internally, establishing relationships. Michael Board getting a pie in the face, those kind of things I think are important. And each organization or group has a different focus, it seems, and some really good creative ideas. So with that, happy to take any questions. And that's my report.
Are there questions for Ryan? Won't surprise you, I'm going to have a question about the office. Can you tell me what your best guess is for when you will get the floor plans worked out? Is there a possibility that someone might rent these in front of us, and because we're taking so long, and 3rd. Right now we spend a fair amount of our meeting time of trustees at either Heine Brothers or Starbucks. Will there be a small office in the investment office that would allow for small meetings like that?
So there
Steve
will
probably
be a
saying no.
conference room. There is a conference room in all the designs. Steve's indicated that he's likely to sit in the pit, which is more kind of how investment strategies work. So, his office would be open. So certainly there is going to be some space in there, and we're on round 2 of revisions with facilities and sport services. Rebecca, do you have any? It's hard for me to give a time frame with the fact that they're driving the ship and they're understaffed. So Rebecca, are you on? Do you have any estimate? I do not at this point.
I wouldn't, it would be a guess. I'm actually meeting today, this afternoon, to finalize it. I'm hopeful that that means it'll be our last round. Last time that took about 3-4 weeks to get back from them because their drafters are the real issue. And so as far as their staffing issues, so it took a little bit to get back, but they've been responsive and helpful. It's a good team. It's just drafters are short. I do think there's a little bit of risk of losing a place, but so far that's not happened. And I think we're close. The places that we're looking at, 2 of them are already empty on the inside, or mostly empty. So the demo would be limited. They had given us kind of about 90 days if it was limited demo, and 120 if there was more demo to it. So if we're 45 days from signing a lease, then those are my best guesses for the lines, but those are fairly optimistic guesses.
Yeah, I just remember back when the legislature told us the finance cabinet promises they will do this, and they sure didn't. Okay.
I had a question on the office space. We already have furniture we need, so there should be no delay in that.
We don't have the pit area that they want. That's unique furniture. But I don't know. We're ordering new furniture for the lobby area because we haven't had a interesting piece there, and that's been delayed multiple times. So
Okay.
I don't know about the furniture.
Thank
Steve
you.
can sit in the floor, I think.
Tables.
I have a lawn chair I can use, so I'm good.
There you go.
Yeah. Okay. Any other questions of Ryan? Okay. New business. I only have one area for new business for the committee, and that is the CERS board made a decision to expand the KPPA joint audit, or not joint, the KPPA audit committee, and it was made up of all KPPA board members. CERS decided they wanted to add a additional person to it that was not a board member of KPPA, but only a board member of CERS. When they did that, that put us in a position of unbalance where we're keeping committees balanced. So we made a decision for KRS to expand, and Mary has agreed to take that position on the audit committee. And thank you, Mary. Any other questions on that? Okay.
Madam Chair, were they not aware that the C board had members on that committee?
No, they were. They wanted to have a non-KPPA member that is a CERS member. And
are they concerned KPPA members are drinking some kind of Kool-Aid that is adverse to the C board? I don't understand.
I don't know. I think one of the things is that they had a person that was qualified that was, I guess, CFO of Owensboro, so they had a qualified person to go on it, and they were interested in having him participate. So it was I think both having someone interested and having the desire to have more information. I questioned it too, David, because it seems like it's that kind of step going back more towards the former KRS structure where everybody's on every committee.
I would just say bless their hearts.
Yeah. But anyway, we can thank Mary for agreeing to participate. And so have fun. Okay, that's the end of the regular agenda. And now we have.
Madam Chair?
Yeah. Yes.
Well, just while we're still on the regular agenda, I guess I just wanted to say, in reflecting on the agenda so far, I know that the leadership of the staff is undergoing a transition with the change of the executive director, but I am just consistently impressed by the extent to which our members are served, by the expertise of our staff. When you think about the way Connie is able to handle the insurance issues, it is just clear that she knows A to Z, everything there would be to know about the state healthcare plans, how it impacts our members, the interface between laws and regulation, our investment team, just everyone we've heard from today on the staff side. Sometimes it's easy to take all of that for granted, but I am just, like I said, consistently impressed that we are so well served by a very knowledgeable team. And I hope our members are as proud of the work they do that this board is. So I just wanted to mention that, and thank you for giving me the chance to do it.
David, thank you. And I think you could probably get everybody that's on here giving you a thumbs up that we all see that. So thank you for bringing it up. Okay, next is our closed session. And is there a motion to enter into closed session pursuant to discussing pending litigation? Is there a motion?
So moved.
Okay, but David, is there a second?
Second.
Okay, I didn't ask for any discussions, but I'll ask now if there's any discussion. With that, the motion is adopted. And if I could.
Right, take a vote, Betty, or Lynn, and Betty on the brain there.
Yeah, I'm trying to, get something off my computer. Okay, so all those in favor?
Aye.
Aye.
Opposed? Hearing none, the motion is adopted. And following the passage of the motion, but before recording and stopping the following needs to be read. A motion having been made in open session to move into closed session for a specific purpose, such motion having been carried by a majority vote of open public session, the committee shall now enter into closed session to discuss pending litigation pursuant to KRS 61.810C. Okay, with that,